Yeah. Just a second. Yes. Uh, Hi, this is Ravi Kanth Miriyala. Right. Today we have, as part of quick revisions of all the standards. Yeah. If you have seen, I have done already. 50% of Ind AS quick revision is already completed. The remaining standards quick revision, I'm just taking it up and will be completing it in some days. Okay. Right. And this is quick revision, but it's almost like a detailed revision, actually speaking. Okay, right. Now, as part of that, our program, we are going to do this. What is that? Ind AS 110, consolidation of financial statements. Yeah, practically this is a big, for solving the sums and all, it's big, but concepts revision will not take too much time. Yeah, that's why I kept only 1 hour. That I feel it will be more than sufficient. Okay, right. And before getting into the subject, yes, let's look at one small information. Yeah, I'm dealing financial reporting for CA final, right? This batch, there is one batch, upcoming batch, January 27th, we are starting. Yeah, actually, it will be having, morning and evening. First, right, first from January 27th, approximately 10 to 15 days, we'll be having only morning session, and afterwards we will be having morning and evening, both the sessions will be there. Okay, morning session will be 6:30 to 9:30, evening session also 6:30 to 9:30, 3 hours, right? And I told you after 15 days when we start both the time, that means 6 hours a day we will be taking it up. And I think 45 days, maybe because of this first 15 days lag, correct now, we may take like 60 days approximately. Within 60 days totally 270 hours is our budget. Okay, total 270 hours we will be able to complete the entire syllabus. Fine, right? That is the first information, right? And here in this I will be covering 100% of ICI material, your PY examination questions and RTP questions, mock questions, everything is going to be covered. Every concept is going to be discussed in detail. That I am very much sure it will be helpful to you. And next, GFRS course, which is not 21st July, which is going to start from 10th January. 10th January. Okay, 10th January we are starting a new batch. This is again 6:30 p.m. Yeah, this this is also only for what do you call, like 25 days class, 25 into 3 hours, that is 75 hours. Will be completing entire ICI material as well as mock test papers and previous examination questions. Everything is going to be discussed. Wherever the concepts, wherever the difficult concepts comes, yes, obviously those difficult concepts also will be explained first, and we will be applying the same concept practically. Okay, right. And this, there is Unacademy, there is one program, CA Iconic program. This is for CA final. Yeah, it is a premium program which will be helpful to CA final students a lot, that I can assure you, right? As part of this program, the best part is what? Doubt solving. Yeah, you will have a mentor. They will appoint one mentor. That man will help you to clear your doubts, right? Whatever the doubts, if they're not able to clear it, then obviously they will divert it to us. Obviously we are here to help you. Fine. At the same time, evaluate test papers. Yes, you will be getting the soft copy, and you will be writing the test physically, and you will be sending it. That will be evaluated. Afterwards, discussion takes place, and will point out where are you lacking the marks, and where you need to change the style of preparation, and where you need to focus. Correct now, something like that discussion will be happening. That will obviously be very much helpful to you. Okay, and as part of plus course, right, you don't get a printed books. This is what one more advantage, printed material will be available. Like as part of that, my Ind AS Made Easy book, right, FR Made Easy book, that both the books will be available, will be given to you. Physical books will be given to you. Okay, right. These are all additional benefits compared to plus program. Yeah, this is the information. Next, evaluated test papers. For each paper, for each subject, 3 tests will be conducted. Once you complete 40% of your syllabus, one test, right? 80% another test. Once we complete 100%, then one more test will be conducted. Correct? That will be giving you a good comfort, right? That is the evaluated test series ka information. And yes, use this YESHAS code, YESHAS LIVE live, right, for iconic subscription. Right, for iconic subscription, this iconic subscription is there for CA final group 1, group 2, and both combo groups also. This concept is available. Yeah, use this code. You will be getting 10% of what is that 10% discount also will be available to you. Okay, my dear. Right, this is the basic information. Chalo, let's go ahead with our today concept. Fine. Yeah, today, as I told you, this charts are from my textbook, that is quick revision fast track charts on financial reporting. Okay, right. This has everything in the sense, I mean, all the Ind AS, entire financial reporting chart book, right? And today we are reading it from here. Obviously, all the revisions I have read it from here. This will be covering elaborative discussion will be here, right? This will obviously be very much helpful to you. Okay, my dear. Yeah, just a second. Just a second. Give me a second. It's okay. Done. Yeah, Ind AS 110, consolidated financial statements. Yeah, see, what is consolidated financial statements? Obviously, consolidated balance sheet, consolidated P&L, consolidated cash flow statement and notes, and statement of changes in equity. Right. As you know, this consolidated financial statements are prepared as a group at the group level. Right. Legally, individually, each company may be different. Correct. From the legal aspect, it is different. But these companies work as a group. Correct. No, as a group. I am the holding company. We work together. Maybe the forms are different. Correct. No? So the financials of a group as a whole. Right. We are going to present it, the group as a whole, as a single entity. We are going to present the single economic entity. We are going to present the financial statements. That is first point. Right. So first, when I use the word group, yeah, group means first parent company, subsidiary company, fellow subsidiary company. Group means that much. Okay. Associate company under 110, obviously the associate company and a joint associate company, joint venture companies are obviously not going to be discussed. The simple reason, we do not have control over those things. Correct. Na? Associate company means what? Associate company wherein you have significant influence. That's it. You have only significant influence. And when it is a joint venture company, we have a joint control but not 100% control. Yeah, joint control, he will not decide the things, right? But his permission is required. His permission is required does not mean that he can decide everything, right? So that is the reason these two are dealt by Ind AS 28. Yeah, in case of consolidated financial statements, obviously with respect to interest in associate and interest in joint venture, you are supposed to follow equity method. Okay, you are supposed to follow equity method. Fine. Right. Next. So right, is it every company has to prepare consolidated financial statements? Not exactly. There are some exemptions. They have given 3 conditions. Actually, 3 conditions are given. If you satisfy all the 3 conditions, that company does not need to prepare consolidated financial statements. That company does not need to prepare. It is exempted. Exempted for what? Right. When will they get the exemption? Once the company should not be listed entity or not in the process of listing. Right. If you are a listed entity, you don't have such exemption. You have to prepare consolidated financial statements mandatorily. Okay. The first company, what is that? It is neither listed nor in the process of listing. That is one. Next. And we have to, well, first of all, we have to inform. Suppose, see this company, right? See, this is the ultimate holding company, I will say. This is one subsidiary. This is sub-subsidiary. Okay. Actually, this company also has to prepare consolidated financial statement. This company also has to prepare consolidated financial statements. This exemption is obviously and never applicable to this UH. UH means ultimate holding. Okay, right. But this exemption can be applicable to this company. Subsidiary company ko, yes, it is possible when subject to these three conditions. Right. Suppose this company has 90%, ultimate holding company has 90% stake. That means remaining 10% is held by NCI, non-controlling interest, that is held by other party. Some technical issues. Just a second. Yeah, I think it's fine. I repeat the last part. Due to some technical issue, it was not streaming properly. Fine. Ultimate correct. I told you S company can get the exemption subject to conditions. Yeah, what is the subject to condition? The conditions are very simple. First one is S company should not be a listed company, are not in the process of listing, right? And the second part is what? Consolidated, correct. And second part, they have informed NCI and NCI has not objected the same. They said it's okay, you don't need to prepare consolidated, prepare only standalone financial statements, that they have given the information, confirmation to them. And the third one is this ultimate parent company, correct, it must be preparing consolidated financial statements, and it must be making it available. It must be preparing consolidated statements as per Ind AS. Okay, as per Ind AS, it must be preparing consolidated financial statements, and it must be making it available to the public. Yes, making it available to the public. That means this NCI, if they want to look at, then they will be able to look at. Under such circumstance, yes, it is permitted. It is permitted. Okay, right. And the second part is post-employment benefit plans. Post-employment benefit plans, even though the company has control over it, okay, but any benefit, suppose employment benefit plan is gratuity fund, basically provident fund, correct? Provident fund. Yeah, company has a control, because from company side only people will be, correct? Company side people only will be controlling that entire trust, gratuity trust, when I say, right? But even though we have the control, but it's not going to add any economic benefits to us. Yeah, from the fund, if the fund is earning too much money, good money, that will be transferred to employees. It's not going to be transferred to the company, right? Company, correct? That is the reason that is not going to be consolidated as part of my consolidated financial statements. And next, if it is an investment entity, what did I say? It is an investment entity. Okay, if it is an investment entity, then also yes, it is not. What is investment company? It is like a mutual fund. It pulls the funds from number of people. Okay, and that money is going to be invested into shares, correct? It will be into, correct, it will be investing into shares, debentures, mutual funds, further, something like that. That is, objective is not to control the other company, to get the dividend income, capital appreciation, to get the interest income, such a kind of objective it has. So these investment companies also do not need to prepare consolidated financial statements. Okay, right. Under section 129 subsection 3 of the Companies Act, a company who has a subsidiary or who has associate or joint venture has to prepare consolidated financial statements, right? That means who has one or more subsidiaries has to prepare consolidated financial statement. What is first of all, when do you say it is my subsidiary company? When do you say it is a subsidiary company? I say it is subsidiary company only when I have control over it. What did I say? Only when you have control over it. Okay, right. I have control. That means other company is subsidiary company, and my name is holding company or parent company. Okay. What do you mean by control? Yeah, there is a big definition. There's a lot of discussion, but from examination point of view, theoretical questions are, very rarely asked so far, right? I can say not asked, but I don't know whether when are they going to ask you. Got it? Right. That is the one reason. Where the investor first control. What do you mean by control? Control, when do you say we have control? We are exposed to variable returns from the involvement. Right? We have a power. With that power, we will be taking part. Not taking part, we will be deciding the operating and financial policies of the company. With this power, we will be involving into the activities of the company. By involving into the activities of company, my returns will be varying. Yeah, if the company earns good, then automatically I will earn correct because it's my percentage stake. What is your stake? I have 60%. 60% of what? 60% of profits. Okay. If my involvement leads to increase in profits, then automatically my share will be 60% of whatever comes. Correct? 60% of whatever comes. So that is the basic reason, right? So next, applicability to affect those returns, though its power over the investee. Correct. So consider all the facts and circumstance of each case. It's not so easy to decide, right? In many cases, it is easy. Correct. Generally, who has the control over the board of directors? I can say, suppose there are 5 people are there. Out of five board of directors members are there. Out of that, 3 people are elected by me. That means I have the control over the board. When I say I have the control over the board, then automatically we are controlling the other company. Okay, we are obviously controlling the other company. One second. Right. So that is the matter. So, but anyhow, some situations, some circumstances can be like this. Even though I have 55% stake, voting power, but I may not be controlling it. But that kind of examples you will see it very rarely. Recently, I have seen one such situation. Our company has 49% stake only. Other company has 51% stake. But as per the mutual understanding agreement between the parties, due to some reasons which I cannot share in the classroom, obviously. Okay, right. Because even though the person who has got 49% stake, he has appointed 3 people to the board, and the 51% wala, he appointed only 2 people to the board. Now we concluded, right, every facts and circumstance I can't give you in this quick revision class, obviously, right, we concluded 49% wala only has to consolidate as per Ind AS, and the 51% wala need not consolidate. For them, it is like an investment in associate. They will follow Ind AS 28, and this 49% wala will be following Ind AS 110. It's like that. Okay, right. So in deciding the factors for control, okay, you are supposed to consider. What is that you are supposed to consider? Purpose and design of investee. Correct. Now, why this new subsidiary company has been formed? There must be some reason, my dear. Correct. Now, what is the objective? Who formed it? Right. A design, the structure of board structure, everything is important to our decision. Correct. Now, that is why is it formed? Right. What is that? Straightforward answer will be available. Done. I don't know today, due to some reason, some technical issues, which not able to understand for the first time like this. Okay. Yeah. Let us continue the discussion. Okay. Right. So, I told you in some circumstances what will be happening. Who is controlling the activities? Suppose if you say up to some level one person is controlling, and the later level the other person is controlling. If it comes to a conclusion like that, then up to some time in the sense, say first 4-5 years. Okay, first 4-5 years, party A is going to consolidate the financial statements, and the next 4-5 years it's going to be controlled by other party, or sometime like that from now onwards. So far you were controlling, A was controlling, now B is controlling. So now from that day onwards, B will be controlling. That means B will be preparing the consolidated financial statements. B will be preparing the consolidated financial statements, not necessarily A, right? It doesn't mean that I started preparing consolidated financial statements. Does not mean that I only will be continuing preparing the consolidated financial statements throughout the life. That is one important point to remember. Okay, next, determine how the decisions about some relevant activities are made. Who is making the decisions? That is one important point. Yeah, right. First, how are you doing it? By means of voting power or by other rights? Yeah, here by means of voting power means it is normal voting power is one, which we know, that is by having equity share capital, you will be able to do that job. Correct. Next, potential voting rights. Yeah, with the help of the potential voting rights also you may be controlling it. Yeah, what is potential voting rights? I have options to purchase the shares. Yeah, correct. No, that is potential voting right. This word you must have used it. You must have heard it in Ind AS 33. That is earnings per share. For calculation of diluted earnings per share, okay, you must have used it. Next, other contractual arrangement. Yes, which I told you sometime before in one of the company which I have seen. Right, there is this problem is there. I mean, because of the arrangement agreement between the owners. Yes, one party is controlling the other party. Yeah, and there is a de facto power. This I will explain you. Obviously, it is assumed, correct? Even though we don't have voting power 100%, I mean more than 50%, still it is considered that we are only controlling. Okay, it is basic assumption because it is the in reality. De facto means in reality we are controlling, even though we don't have 100. I mean more than 50% voting power. Right. Next, yeah, here the evidence of practical ability to direct. Who has really the practical ability to direct, that is supposed to be considered, not because of the voting power. Next, is there any special relation depending upon the situation? Yeah, is there a large exposure to variable returns? So many things you are supposed to consider. Yeah, look at one by one. Obviously we look at it. In case of potential voting power, the first point which we are talking, when do suppose I have an option to purchase another 30% of voting power. How much do I have already? Sir, I have already 40%. Oh, you have already 40. If I purchase another 30, I have right to purchase another 30. Now the question is, it's like same as Ind AS 28. Do I have the right on the 31st March? First question mark. Yes. That means I will be able to exercise my option even on 31st March. Even though I have not exercised it as on 31st March, do I have right? First point to check. Second point, will it be economically substantial? I mean, is it going to be, suppose if I exercise that 30% stake, correct? Is it going to be, I mean, good to me? Good to me means financially, I mean, if I exercise, that is going to benefit to me. If you say yes, then you can, correct? You can say that I have control. Even though I don't have more than 50% on 31st March, still I will be considered as holding company and I will be preparing consolidated financial statements. Okay, when it has right to exercise on the balance sheet date. What did I say? I have right to exercise. Okay, I have the right to exercise on the balance sheet date and the practical ability to exercise those rights. Yeah, that's what I told you. Practical ability means not just only making the payment ability. It is not just only financial ability to exercise. If I exercise, will it be economically beneficial? If it is economically beneficial, substantially or significantly, then obviously I am going to exercise my options. Otherwise, I will not. Okay, right. Next, here like we are able to, how other rights are able to appoint or reappoint the key managerial personnel. Yeah, because of the arrangement, special relationship, could be any reason. Able to direct to enter into a significant transaction. Yeah, these are all some examples. When we go further down, we'll be able to, I mean, we'll be able to understand. But one thing is true. From examination point of view, so far they have not asked a question from this area to decide whether the company, who has to consolidate financial statement. They have never asked such kind of theoretical decision making questions. That's why I am not focusing too much on this. Okay, that will be waste of time for us, correctly speaking. right? That's why I'm directly getting into the consolidation. Okay, right. What is this consolidation? Consolidation, generally what do I do? Right, see, every teacher, especially with respect to consolidation, my dear, every teacher will have their own style. Yeah, one teacher will teach one style of consolidation, but end of the day, all the teachers' balance sheet total amount will be same. Okay, right, but style presentation will vary. So I don't know how your master taught you. Correct, na? If you are my student in an academy, then obviously no problem. You will be very much convenient. Otherwise, you may find little difficulty. Okay, right. So that's, just keep it in mind. First one, what do you say? First step one, what do I do generally? Establish the group structure. Means what? First, who is parent company? What is the date of acquisition? What is the date of balance sheet? Okay, what is the degree of control? Like that. Date of acquisition, date of balance sheet, degree of control. Degree of control means how much percentage we hold and how much is held by NCI, non-controlling interest. That's all we'll decide. Just basic information, nothing much. Next, step 2 is what? Something very crucial to us. Yeah. Step 2, if you are able to complete it perfectly, no, almost as per my steps, consolidation is done. That's it. It's very pretty simple way we have done it. Actually, very simple. Whichever the student has learned from me, if you ask them, they will tell that it's very simple. Simply will be able to complete it. Okay, done. Now particulars, right, on the date of acquisition, date of balance sheet, and post acquisition. Yeah, right. Now the matter is what do you do? We'll divide like this. On date of acquisition, what are the balances? What is that you will take, sir? Equity. Actually, look at the net assets of the subsidiary. I told net assets. Net assets means assets minus liabilities. I also know, but I will take the other way around. Other way around is equity. Equity means equity share capital plus reserves and surplus. On which date? On the date of acquisition. That's what. Look at share capital, right? Secure. What is that? Writing permission. This is, obviously wrong. No problem. Security premium or something like that. Okay, security premium. Okay, security premium. Yeah, that is security premium. And retained earnings, revaluation reserve, and surplus. Retained earnings, it's okay, whatever it is, right? So this is the total. We will take it, right? So on date of acquisition, on date of balance sheet, okay, right? What is on suppose example, retained earnings. Retained earnings is equal to 100 rupees. Okay, on the date of acquisition. But today it is equal to 120 rupees. It became, how much it became? 120 it became. Okay, fine. So if it becomes 120, that means E20 is earned after acquisition. Yes, correct. If this date of acquisition, whatever is the balance number is coming, that will go to step 3. What is your step 3, sir? Step 3 is nothing but here calculation of goodwill. Correct. Na? Goodwill calculation. What are the net assets on the date of acquisition? That only has to come here, right? So that's why E number I am obviously going to take it in goodwill or bargain, gain from bargain purchase option, bargain purchase. Step number 3 purpose I will be using it. Okay, on the date of balance sheet, on the date of balance sheet, yeah, these numbers directly will come from the material, whatever, question say number automatically it will come. Correct. Post acquisition, yes, here whatever the profit, whatever comes in, out of this, what will be there? What will be there? We will say NCI share is something, obviously. At the same time, that is NCI share, at the same time parent share. Yeah, parent share, which I have noted it here, which I parent share, NCI share, will be giving it like this. Okay, right. Next, one question can come. Suppose, sir, step 2, sir, step 2 may, you are telling this total will be taken for step 3 purpose, that is calculation of goodwill or bargain purchase, gain from bargain purchase. True. Suppose, sir, book value is equal to 1000, sir, one asset, land example. Okay, book value is equal to 1000, but fair market value is equal to 1500. Under that circumstance, what do I do? Under the date of acquisition, right, I will add it here somewhere. Okay, plus fair value adjustment, something like that. I will write one line. What do I write? Fair value adjustment. Okay, if I write fair value adjustment, then that will be more than sufficient. Correct. Now that 500 I will be incorporating as on the date of acquisition. Okay, 500 I will be incorporating. Okay. Yeah, 500 I will be incorporating. 500 I will be incorporating here. Then automatically it will come to exactly. Got it? Yeah, that is the basic thing. Actually, it's easy in this way. Now, suppose that this is a plant and machinery, sir. Cool, right? Plant and machinery, it has gone up fair value. It has gone up today by 500. Okay, I will take it under DOMA. I will take 500. But sir, subsequently there is a depreciation. Yeah. The depreciation. When is the depreciation? I mean, the depreciation is pertaining to which year? That is later year, sir. Correct. After acquisition, excess depreciation or less depreciation must be there. Correct. That will be automatically adjusted in the DOB, so that effect will come automatically on the post acquisition. Yes, this is post acquisition excess depreciation or less depreciation, that will be considered automatically in the post acquisition. Okay, right. Next, calculation of goodwill or capital reserve, which is nothing but gain from bargain, which you have learned it as part of Ind AS 103, but just I will recall once again. Okay, right. So first, what do? The fair market value of cost of investment, fair market value of purchase consideration, or whatever you say, purchase consideration which you gave on the date of acquisition. Okay, done. That's all. Not that's all. And plus NCI. This NCI, as you know, NCI on the date of acquisition. Okay, you have accounting policy choice. One, you can measure it at fair market value, and the second option, you can measure it at proportion to the fair market value of net assets. Proportion to the fair market value of net assets. Okay, that proportionate also you can measure it. That is only on the date of acquisition. Whatever that is NCI, that number will come. Plus, and if you have any already, correct, now before the date of acquisition, before getting the control, if you have already acquired something, some shares if you had already acquired, fair market value of those shares also is supposed to be considered. That is fair market value of investment in subsidiary which is already acquired, minus fair market value of net assets identifiable net assets. You got my point? Fair market value of identifiable net assets. Is it identifiable or not? That's all. Identifiable means what, sir? Separable. Okay, it may be recorded by the other company in the sense selling company. It may not be recorded by the selling company. It just doesn't matter to us. Okay, right. That will be taken into this. Then the difference amount is going to be either goodwill or a capital reserve. Yeah, whenever there is a capital reserve, as per Ind AS 103, what it asks, is it correct really capital reserve has come? Because it's a gain, my dear. Why will the other company sell themselves for less than the fair market value? Obviously, very difficult. Correct, very rare circumstance. That's why they say recheck entirely the fair market value computation. Okay. Till if you find no, they sold it for cheaper because of some practical reasons or something like that, under some circumstance they sold it, otherwise they would have not sold it, something like that. If you can prove it, then that capital reserve amount will be routed through OCI and sits in reserves and surplus. If it is not, if you are not able to show the evidence for it, you got my point. If you are not able to show evidence for it, then it cannot go to what do I say? It should not be transferred to OCI. It will directly go and sits in reserves and surplus. Okay, right. Next, step number 4. I told you totally 5 steps. Out of 5 steps, this is 4th one. NCI, which is very easy concept. Yeah, NCI, whatever you have measured just now. Correct. Now, where have you measured, sir? Here only I have measured. NCI I have measured. Na? Yeah, this measure, the other number, same number is going to come here. Just a second, power off. Yeah, sorry. NCI which is taken in step 3, that is here. This NCI number, the same number is going to come here. Okay, That is, what is this NCI? This NCI is as on the date of acquisition. That I told you, as per your accounting policy, whether it is fair market value or proportionate method. That's all. But on the balance sheet date, there is no such policy. Only on the date of acquisition, you have such policy. Okay, right. Next what? NCI share in the post acquisition profits. Yeah, maybe you acquired in 2020. Today 2021, 1 year time is up. Correct na? In this 1 year period, your company must have earned. Correct na? Your company must have earned some profits. Obviously. Correct na? Profits, you are supposed to take it here. Correct na? Share of NCI. Yeah, I mean, parent share will be considered in step number 5. NCI share will be considered in step number 1. And not only that, impairment of goodwill. Correct na? What is that I said? Impairment of goodwill. Yeah, impairment of goodwill, NCI share also supposed to be considered. NCI share also should be considered. I will explain you here one small point. Yeah, when I say impairment, my dear, impairment of goodwill, who should consider? Impairment of goodwill, who should consider? It is depending upon NCI's valuation, that is accounting policy. Are you going by proportionate method? Are you going by, yes, yeah, are you going by the fair market value method? Okay, if you are going by fair market value method, one second. Oh, yeah, if you are going by fair market value method, you understood my point. If you're, because I told you there is one method of proportionate method. Next method is fair market value NCI measurement. If you are going by fair market value method, then the impairment loss on goodwill has to be shared between the parent company and the NCI as per their proportionate percentage. Okay, under that circle, that's why fair market value method only. That's what very clearly I have written. The remaining amount is what? NCI, which will appear in the balance sheet. Where will this NCI appear in the balance sheet? It is part of equity. Okay, it is part of equity, but it is separately from the parent's equity. It is separate from parent's equity. Okay, it is separate from the parent's equity. It will be presented. Got it? Right. Done. Now next, step number 5. Dividend from subsidiary. Okay, dividend received from subsidiary. One small point. Yeah, dividend received from the subsidiary company will be recognized in the P&L. Yes, it will be recognized in the P&L of the standalone financial statements. Obviously, as usual, if you receive from the other company, as usual, correct? That's all. And this, in accounting standards, we have a concept called post-acquisition dividend, pre-acquisition dividend. Such concept is existing in accounting standard 13. But such a concept does not exist in Ind AS. It does not exist in Ind AS. That's why whatever the dividend received, that has to be transferred to profit and loss only as per Ind AS 109. Okay, na? Right. So what do you do in consolidated financial statements? It is very simple, my dear. It is an intercompany transaction. It will be eliminated in the consolidated. Correct na? It will, because you are considering holding and subsidiary as one entity, single entity, and considering that only you are preparing the consolidated financial statements. Correct na? Then how come I can pay myself a dividend? Obviously no. That's why that will be eliminated. That is going to be eliminated in simple terms. That's it. Okay. Step number 5. Right. Step number 5, what is there? Step number 5 is nothing but profits. Okay, one second. I think it's, yeah, no problem. Step number before, yeah, I think step number 5, information has come here and there. It's okay, doesn't matter. Step number 5 is nothing but group retained earnings. Okay, group retained earnings means that is the parent company retained earnings. Yes, parent company, their own profits plus our share of, correct na, parents subsidiary share, correct na, parents share of post acquisition profits. This is not parents share. Parents share of post acquisition profits. Yes, that number also will be taken. Okay, right. At the same time, yeah, that has come from where? Step number 2 se aa gaya. Plus parent share of any impairment loss on goodwill, and there may be some plus or minus, some adjustments can be possible, plus or minus some adjustments may be possible. Okay, that is subject to thing. Okay, fine. Next, step number 6, what I prepare, that is nothing but consolidated balance. It is not a separate step. Consolidated balance sheet. What will happen? Obviously current assets will be taking as it is, correct, and goodwill, yes, which is computed in step number 3 will come here, right? Investment in subsidiary will be eliminated. That's why all the assets and liabilities are coming up. Even current assets also, now obviously parent plus subsidiary numbers will be taken, correct. Non-current liability, current liabilities, yes, parent company number, subsidiary company number, minus if there is any intercompany owings, correct, intercompany balances, if there are any, those will be eliminated. Other than that, everything will be perfect, right? Next, capital reserve, if it comes from step number 3, and NCI we have told you already, correct, that number is going to come. Equity share capital, this is of the only parent company, okay, only parent company ka what is that? Only parent company ka share capital is going to come here. Fine, right? Chalo, let me look at one by one information, little more. Yeah, different reporting period. Yeah, different reporting period. What is different reporting period? Parent company is preparing financial statements on 31st March, example, but subsidiary company is preparing on 31st December. Yes, there is a gap of 3 months, right? But strictly speaking, what are we supposed to do? No, you mandatorily you have to ask subsidiary company to prepare financial statements as on the parent company balance sheet date. You have to ask them, they will prepare it. Based on that financial statements only, you are supposed to perform consolidated financial statements. Okay, right? Due to some unforeseen, which is like, sir, this is hardly any small company, sir. The financial impact is nothing, or it is impracticable to prepare such financial statements. It is, the benefit of preparation is equal to this much, sir, and the preparation cost will be this much, sir. If anyone says, under that circumstance, it's okay, it is accepted. Accept in the sense, we will take the subsidiary financial statements as on 31st December only, and we will consolidate with 31st March. But E 3 months gap may, what is that E 3 months gap may, sir? The intercompany transactions. What did I say? Intercompany transactions will be considered. You have to account it. Okay, not only intercompany transactions, and any other significant transaction, normal business sales or purchases, that we don't consider. But intercompany sales, intercompany purchases, intercompany royalty, intercompany dividend, all that will be considered. That will be accounted for, and any significant transactions also will be taken into account. Okay, na? That is what, right? Next, change in the proportion of NCI. Yes, change in proportionate. In the sense what? NCI was 40%. Okay, then now NCI has become 20%. Okay, that means because I have acquired 20% more. But the point is, my control was also control. Now also it is control. Am I controlling the other company? Yes, obviously, 100% I am controlling the company. So since we are controlling the company, we don't need to recalculate goodwill. That's what we told here. No need to recalculate goodwill or capital reserve. That is first and foremost thing. Okay, next. Parent is buying further or setting existing shares, correct, now without losing. That's a different. Why is it change is happening? Now, what are we supposed to do, sir? Very simple, ma. Okay, yeah, NCI is increasing, decreasing, na? Correct. NCI is decreasing. Suppose example, NCI shows credit balance. Yes. Now it is decreasing. Decreasing in the sense debit karo. Correct. At the same time, you must have given some cash or because you purchased 20%, na? Correct, obviously 20% you purchased, 20% ke liye you must have given some purchase consideration. Yes, difference amount difference amount you can directly adjust it with retained earnings. Retained earnings number, it can be debited or it can be credited depending upon that is a balancing figure basically. So balancing figure can be a debit, a balancing figure can be credit. Obvious. That is with respect to change in NCI. Yeah, this you have given NCI shares increased. Yeah, increased in the sense we sold some part. Correct. You sold some part means you must have got cash. Right. NCI increased means NCI account is supposed to be credited. Balancing figure will be retained earnings. Same way, NCI share decreased. Yeah. It decreased in the sense NCI shows credit balance. You are debiting it. You must have received some cash or share consideration. Something you must have got. You must have paid it. Which you paid it. We are crediting it. Correct. The remaining balancing figure is going to be my retained earnings will be the balancing figure. Okay. Right. Next, NCI related little more information we have given it here. Yeah, it presents separately from the parent's equity. I told you it's part of equity, but first parent's equity will come, then we'll say add NCI, then we'll say it is total equity. Yeah, and we are not showing it as a liability because we are no way liable to any company as on 31st March, we are not liable to anybody. That's the reason we are supposed to present it part and parcel of equity. We are strictly going by the definitions. Okay, liability, correct. That's why we are showing it as an equity since we don't have a liability. Done. On the date of acquisition, yes, we have a accounting policy choice. I told you it can be fair value method or it can be proportionate of net assets, fair market value of net identifiable assets. Next, only on the DOE, fair value option. Correct. But subsequently, you don't have any such kind of option. Okay. Next, NCI as correct. NCI amount will be what? What you determined on the date of acquisition plus, right, plus any change in the equity subsidiary afterwards. Correct. After acquisition of the company, right, after acquisition of the after date of acquisition, whatever the changes to the equity of the subsidiary company, some portion will be, NCI share will be coming there. Yeah. Yes, NCI we don't actually, each element of share we are not going to correct now. Even though it is a negative balance, NCI will be presented negative balance. Right, as per accounting standard, for your information, as per accounting standard 21, NCI means minority interest, will present it maximum to the extent of 0. But here, no, because we are not going to bear. If there is a loss, their portion of loss, they only have to bear it. That's the reason NCI can be a negative number. NCI can be a negative number. Remember this point. Right, with respect to Ind AS 28. With respect to Ind AS 28, investment in associate or joint venture can become 0 but not negative. Okay, but here NCI, correct, NCI can be negative. NCI can be negative. That is the small difference is there compared to Ind AS 28 compared to AS and Ind AS 110. Okay, if subsidiary has outstanding cumulative preference share capital. Okay, outstanding cumulative preference, cumulative, you need to remember this. Yeah, which is classified as equity. Then under that circumstance, deduct the preference, correct, deduct from the profits of the company, from the profits of the subsidiary, cut the preference dividend, even though it is not declared. Correct. Deduct the preference dividend from the profit and loss and later only you allocate it. In the sense, subsidiary earned 1 lakh profit. Okay. Preference dividend, say example 20,000. Okay. 1 lakh first 20,000 cut karo. 80,000 will come. 80,000 has to be bifurcated between parents' share and NCI share. It's like that. Okay. Right. Next, investments acquired during the year. Suppose we have acquired the shares in the middle of the year, sometime maybe like, then you allocate the profits of the subsidiary, assuming that subsidiary earned the profits evenly throughout the period, and allocate it on the based on the time basis, time proportion basis may allocate it. That is the point. Okay, done. Next, acquisition of interest in subsidiary without consideration. Yes, it happens when it happens, yeah, we didn't pay anything, but we got the control. Yeah, maybe see, I have 45% stake in the company. How much percentage? 45. That means other party has got 55% stake. Correct. What the company has done? What the company has done? They bought back only the other party. Say this is B, this I am A. They bought back 20% shares of them. 20% you bought back means it becomes 35. Right. So in the new company, out of what is that? Say example, 45 plus 35 is equal to how much? 80. 80 may 45 is held by me. That means I got the control. It is possible. It is possible. Or maybe as per the agreement, I have got the control after a certain period of time. Correct na? Right. So that's why I have not paid any fresh amount. Fine, but I have already 45% in a stake here. Yep. So this one, the fair market value of this 45%, you have to measure it. That's all. But what is that? You paid purchase consideration. Today payment is equal to 0. Already paid something was there. That fair market value, we will determine it. The book value may be, say example, we purchased for 1000 rupees. Today is equal to 1200 rupees is the fair value. That means 200 rupees will be transferred to profit and loss. It should be transferred to profit and loss. Like that it will be happening. Okay, right. So what are we supposed to do? Fair value all the identifiable assets and liabilities which are measured. That's obvious normal. If fair values are not reflected in the financial statements, but while preparing the CFS, give the effect in step 2. I told you undervaluation, overvaluation. I told you book value of the asset. Book value of the asset is equal to 1000. How much is the book value of the asset? 1000. Right. And but the fair market value of the asset is equal to 1200. Okay. That means E200 is increased on the data. This is which dates are? This is on the date of acquisition. Yep. E200 in step number 2, column number 2. You are supposed to take it. Okay. Then automatically, smoothly, everything will be done automatically. That is the best part of this method. Once you where to adjust at one point, I'll tell you here adjust karo. That's it. Then rest of the calculations, I mean, blindly we will do the calculation. You will get your things done. That is the benefit of it, right? Next, impairment of goodwill. Yeah, impairment of goodwill, I told you it is based on the NCI measurement. NCI is measured at fair value. Then I told you the impairment loss should be given to group also, that is parent share also, and NCI also has to take its share. But NCI is measured at proportionate of net assets. Then it is going to be taken by only group. 100% will be borne by the parent company. 100% is going to be borne by the parent company, but not by the NCI. NCI will not take share in it. Okay, right. Next, suppose our post acquisition revaluation has come. After we acquire the other company. Okay, after we acquire the other company, subsidiary has revalued its assets. Okay, there is a revaluation reserve came in. Fine, no problem. A revaluation reserve 100k. Out of that, yes, NCI will be, say example, NCI is 20%. Our stake is equal to 80%. In our group reserves, revaluation reserve 80 will be presented. Automatically NCI share, NCI will get, our share, we will get it. Got it? Next, uniform accounting, it is mandatory to follow. You don't have any exception in this case, my dear. No exceptions are available. Mandatorily you are supposed to, means subsidiary company has to prepare such financial statements which are in line with the accounting policies of parent company, Getting my point? Done. Next, intra-group transactions and balances. Yes, intra-group transactions and balances are supposed to be eliminated. Which are the balance? It may be a current account balances. Yeah, it may be loan taken. Correct na? At the same time, right, dividends, interests on loan. Yes, obviously. Unrealized profits on sale of goods and non-current assets. Yeah, unrealized goods. Correct na? Suppose inventory is there. Inventory may profit is there. So now what do you do? Inventory se reduce karo. Correct. Next, is it sold by whom? Is it sold by subsidiary to holding company, yeah, or holding company to subsidiary? Suppose our holding company sold to subsidiary company. Then debit group reserves. Debit group reserve, that means step number 5 may you debit it. No, sir. Subsidiary sold to holding company, sir. Okay, subsidiary sold. Na? If subsidiary has not sold, subsidiary profit and loss would have been lower. So you will be debiting subsidiary profits. That will be, this will be under step number 2. May adjustment will be taking place. That's all. Very simple and straight. Okay, we'll be doing it in this fashion. Got it, my dear? Next. Yeah, we are left with few more small things. Unrealized profits. Unrealized profits, which I told you just now, on sale of goods. Correct, na? Sale of goods. Sold by parent, what to do? Sold by subsidiary, what to do? Which I have explained. So it is non-current assets. Yeah, non-current assets means what happened? What happened? Say example, holding company sold to subsidiary company. What they sold? We sold machinery. Okay, we sold machinery. Yeah, obviously there will be some profit element in it. Yes, there may be some profit element. Correct. So, I mean, maybe cost to me 100. I sold it for 120 rupees. Holding company booked a profit of 20. Now, the point is, if on this 120, depreciation will be charged by subsidiary company. Correct. Now, but when you are preparing consolidated financial statements, as all the entities are going to be one single entity, obviously, when you are preparing as one single entity financial statements, correct na? How can one can sell to other company? I mean, we are all same. I cannot sell anything to myself. So that's why E20 rupees will be eliminated. At the same time, you should give an effect to the financial statements. Even though subsidiary charged on 120, that is excess depreciation, net effect should come if it has not been sold. What would have been the depreciation? That depreciation only should be impacting the consolidated financial statements. Individually, let them do it. But when it comes to consolidation, we will not allow this. Okay, na? Right. Next, multiple stage of acquisition, which I already told you. We'll remeasure the existing stake at fair market value, and the gain or loss that will be transferred to profit and loss. Okay, right. Remeasure previously acquired interest at fair market value, and it will be transferred to P&L or OC depending, but generally it will go to profit and loss. Okay, right, fine. Otherwise, if you say my investment, I have measured it at FET OCI, only under that reason it will go to OCI, otherwise it will not go to OCI. Generally it will be transferred to P&L. Next, consolidated P&L. It is pretty simple, normal. All sales, purchases and line by line will be consolidating. But yes, keep one thing in mind: intercompany sales, intercompany expenses, intercompany dividends. Correct? That those things are not going to be considered. Those things are not going to be considered. It's line by line. Eliminate intercompany transactions, any unrealized profits. Yes, all those things are going to be correct, eliminated. Next, from the P&L point of view, yeah, this is NCI calculation basically. NCI, how do you calculate? Yeah, subsidiaries profit and profit will take it. We will take the fair value excess depreciation less depreciation. Any upward transaction, upward in the sense subsidiary sold it to, then obviously subsidiary profits you have to reduce it. So after making such adjustments, some profits and loss will come. On this, NCI is equal to 30%, then this number will be NCI. Yeah, actually, e-calculation, if you prepare, it's actually easy and it is not something critical or difficult. Fine, right, my dear. That is about your Ind AS 110. Obviously, this quick revision we cannot solve the sums. This is just concept revision, right? Hope you understood the subject, right? Thank you and see you in the next class.